Good morning. Good morning and happy Tuesday. Welcome to another Tax Talk Tuesday. As we are getting started, I'm going ahead and sharing this live out to a couple groups, and I want you to do the same. Go ahead and share this live to a few of your favorite Facebook communities who have business owners like you who need to know about taxes, who need to know about business, and who needs to know about finance. Because every Tuesday we are here at 7 a.m. Central Standard Time, giving you a tax talk on one of those three topics. And today we're going to talk about finances, okay? Today we're going to talk about the money, and I know in business we love to talk about money, or we should love to talk about money, because this is the bread and butter of our business. This is the department, the finance department. This is how we stay in business when we are talking about the money. Okay, so if you are new to me, I am Chastity Grady at Grady Tax Plus. We help keep the IRS out of your pockets so you can live a better life. Why? Because you deserve it. And on today, on this Tax Talk Tuesday, we're going to talk about how to properly pay yourself based on your business structure, right? So the key word is based on your business structure, how to properly pay yourself, because different business structures carry different rules, okay? Different business structures have different rules as to how you should pay yourself in business, and you must follow these specific rules in order to stay compliant with the IRS, and in order to make sure that you are keeping good records, right? Making sure that you are accurately keeping track of your income and expenses. Okay, so let's go ahead and get started, because this is a hot topic and we got some things to cover. All right, so how to properly pay yourself in your business depending on your business structure. So I'm going to start from the top and I'm working my way down. When I say I start my way from the top, I'm going to start my way from the top of the ladder, which is being a C corporation. Okay, I'm going to start from the top. Many people aren't C corporations because people don't understand what it means to be a C corporation, what comes with it. All you hear is double tax and you run far away. And I've already talked to y'all about, like, that doesn't even matter. But just for the sake of paying yourself, okay? So if you are a C corp, right? If you are a C corporation, the requirement is that you actually pay yourself as an employee, right? When you are a C corporation, you have decided that you are cutting down the line, you are drawing a straight line between you as the person, you as the individual, and you in the business, okay? You have completely separated it, right? So what that means with the separation, when you are a C corporation, you do not pass down what happens in the business onto your personal tax return, like some of the other entities that we're going to talk about. It's literally just a clean draw, right? It's very clean. It's the only business tax entity where you can truly separate yourself from the business, meaning your personal return, it will see nothing of what happened on that business tax return. It won't see your net profit. It won't see those things. It's only going to see what it has paid you on a W-2, or if you take out dividends, so a 1099 DIV, similar to what you would get from a bank, right? Or from a stock. If they pay you out dividends, they would give you a 1099 DIV, right? So those are the only two types of income information that you would receive from a C corp, right? So if your business is taxed as a C corp, right, you will be on a W-2. It's a requirement. And if you basically withdraw money, take out money, take out a dividend from the business, then you must report that on your personal tax return, okay? But you don't report any of the business net profit, okay? So that's the only one. Number two, I'm going to talk about is a partnership. So a partnership is when you are in business with more than one person. It's two or more of you, right? And there's two ways that you can receive income or payment or pay yourself from the partnership type. Whether that's through guaranteed payments, meaning as a partner, you're guaranteed to receive XYZ dollars, regardless to how the business is doing, you are guaranteed to receive, I'm just gonna say $500 a month. That's a guarantee. It doesn't matter what's going on with the business, you're gonna receive that $500. That's a guaranteed payment. The other way is from a owner's draw. Notice I did not mention there's a employee option, there's a W-2 option, right? The partnership is the partnership exists because we need one place. We need one place where we are reporting all of the income and all of the expenses, right? That's what the partnership return is for. We need a one centralized place where we get to see all the income that was made from the partners or any employees that work for the partnership, and all the expenses. But what happens is, outside of guaranteed payments, what is going on with the net profit, right? The net profit is where you would pay yourself out of in the partnership, and we call that a distribution. Okay, you're distributing money from the net profit in order to pay yourself. The partnership doesn't have the luxury, like a C Corp, of putting the owners of the partnership as a W 2 employee, right? The partnership is only a business entity to include all of the money, all of the expenses that multiple people made in the business, right? And then from there, you're distributing your portion of the draws, the distributions. Okay. So what does that look like? So let's say in the month of August, the partnership had a net profit of $10,000, meaning you might have made 20,000, you spent 10,000 on business expenses, and you're left with $10,000. Well, if you were in a 50-50 partnership, then technically, I wouldn't advise it, but technically you can take out $5,000 and the other person can take out their $5,000 as their owners pay, right? As the distribution that gets reported on your tax return, or on the Schedule K1 that gets reported on there. But it's not W-2 income. You're literally just withdrawing your portion of the money that's left over that was made. Now, if there's no money left over, then whatever your partnership rules are, is that if you don't have a net profit for that month, you're not able to draw out. That depends on the rules. But at the end of the day, the only way to pay yourself in the partnership is if you get guaranteed payments or if you just withdraw the money. All right. Now we're moving on to number 3. If you're an S corp, right? This is the hot button, right? If you are a S corporation, hot button, right? When you are an S corporation, then you have created a similar barrier, not the same as a C corp, but you have created a similarity where you have separated yourself from employee versus employer, right? There's a slight separation, but the option of being an employer still exists. So what does that mean? So when you're in the S corporation, this is a tax strategy. This is not something that you set up at the state level, unless you are in California. This is a tax strategy. Somebody say tax strategy. S corporations are tax strategies. It is used for people who are partnerships, or the last one we're going to talk about, if you're just a single member LLC, it is used to make you become an employee of the company, right? It is used to make you become an employee of the company, which means that if you are not a C Corp or if you're not an S Corp, you are not considered an official employee of your company, which means that you cannot pay yourself through direct deposit when it comes to being on payroll, meaning you're paying payroll taxes to the IRS. This option does not exist for you if you are not an S Corp or a C Corp. Now, the difference between an S Corp and a C Corp, which is why I love the C Corp as a tax strategy more than the S Corp actually, is because with the S Corp, yes, you are able to put yourself on a W 2. I can pay myself as an employee based on reasonable compensation rules. Okay, based on reasonable compensation rules, keyword, I am able to pay myself. And I am also able to take out money. It's not going to be double tax if I take it out, though, like in a C Corp. But I'm still going to get to why I like the C Corp better. I can still take out some distributions, right? And it's not going to be double taxed. I can take that out as another form of paying me as well. So in the S corporation, you can pay yourself by your reasonable compensation guide, whatever you're reasonably supposed to pay yourself via salary through payroll. You are able to do that, and you are also able to take distributions that won't be double taxed like it would be in the C corporation. But the reason why I like the C corporation better than the S corporation is because when you are an S corporation, whatever the net profit, remember we talked about understanding small business taxes and how a S corporation doesn't have a business tax, and the only entity that truly has a business tax, with some exceptions for others, is the C corporation, which means that the C corporation, when you file that tax return, the bus stops there. You pay the tax on that 21% flat tax rate based on the net profit. But if you're an S corp or a partnership, whatever that net profit is, that gets passed down to the owners, who will report that information on your personal tax return, who would then pay personal taxes on that money. Okay, and this wasn't supposed to be about small business taxes, but let me go there for just a second so you can understand. If you are an S corporation, you pay yourself your reasonable salary, you take out your distributions, but you have a net profit left over. Let's say, for the sake of numbers, the net profit is $50,000. So that $50,000 gets passed down to your personal tax return for you to pay personal taxes on. Well, $50,000 might not sound like a lot, right? And then if you're a C corp, you're paid 21% on that $50,000. Okay, done. But on your personal tax return, if you add that $50,000 plus your W-2 income from various sources that you may have, plus any stock distributions you've taken out, plus any retirements you've taken out, like plus any other types of income that you receive, all of that, including that $50,000, is going to make your tax bracket go above a certain level. So let's say with all of that, it makes your tax bracket go up to, let's say, 33%, for just the sake of saying it. Well, you're going to be paying 33% on that income versus 21% in the C corporation. So you can see how, if you were a C corp, and I'm not advocating for anybody, that's not even what we're talking about today. But you can see how in a C corp, oh, I just paid a 21% flat tax rate and I'm done on that 50,000. But if I'm an S corp or even a partnership, and if I'm carrying that money to my personal tax return, and it's going to add on to the additional money that I'm already going to have on my tax return, then that's going to make me pay more money in taxes, because the tax rate for individuals is varies from 0% all the way up to 37%. So the most I can get taxed at is 37% versus, if I was just a C corp, I'm done at 21. So you see the difference, right? Okay. Like I said, we weren't even talking about that, but let's keep on going. So as an S corporation, you're able to pay yourself. Actually, you're supposed to pay yourself on payroll, and you can take distributions out that is not exceeding what your basis is. But also, what's important to know, with your reasonable compensation, with those distributions, if you have not taken up to your reasonable compensation, so let's say you're supposed to pay yourself $60,000 for the whole year, but you only paid yourself $50,000, but you took out $10,000 in distributions. Technically, that $10,000 was supposed to be through the payroll, because you're supposed to pay yourself $60,000. A lot of people don't follow those rules. A lot of people don't even know those rules. I'm just throwing it out there that the taking the distributions is it. You got to be careful with that, and you also have to follow the rules of what is a reasonable salary. Okay, it's not based on, oh, okay, I got $50,000 left over in my business, then I can just pay myself the $30,000 as a salary. That's not how you determine what's a reasonable salary. And we do reasonable salary analysis for people who are S corps. If you don't know what you're supposed to pay yourself, we look at you and your industry and where you're located. How much are these people, the same people, making if they were to apply to a job with your skill level, right? And if that comes back that, oh, okay, You can pay yourself 50,000. Then that's your salary, right? We got the data to prove that this is what's reasonable for you, right? Or otherwise, if it's reasonable to pay you higher, whatever it is, that's what you base your salary off of, not just being like what TikTok say or whoever say on social media, put yourself on 40K, 50K. Those are like the magic numbers I hear on a salary, and then you're good and you're not. Okay. All right, moving on to the most popular one. If you are a sole proprietor, if you have just a DBA, if you are a single member LLC and you're not taxed as an S Corp or a C Corp, if you're a side hustler, if you're an Uber driver, if you do DoorDash, if you do whatever it is that is not on an S Corp, partnership, or a C Corp tax return, you are considered filing your tax return for your business income and expenses on a Schedule C with your personal tax return. Okay, so we talked about how with the S corp and the partnership, the net profit gets passed down to your personal. Well, when you're filing your return on Schedule C, it's already in your personal. We don't have to pass it down from anywhere else. We don't have to get it from anywhere else. It's already going to be there on the Schedule C. Now, with that said, remember I talked to you and I said that the IRS only considers two types of entities, tax entities. This is why it's a tax strategy, right? A S corp and a C corp, it's a tax strategy. It's not something that you just decide, oh, I can just be an S corp and not because I need to pay myself on a payroll. I just need to be an S corp or I need to be a C corp. It's not just something you just wake up one day and decide. It's based off of facts and circumstances, right? What is going on in your business that can help you save money on taxes? And after looking at all the tax strategies that are available to you, you have decided that the S Corp or the C Corp is going to be the best tax solution for you. Okay, that's what that is for. It's like I said, it's not for you just to be like, oh, I want to be an S corp one day because I need to pay myself a paycheck. No, that's why we're having this live to discuss how to properly pay yourself based off of your business structure, your business entity. Okay, here we go. So on the Schedule C, because we know now that we know that an S corp and a C corp are the only two entities that I can have myself as the owner on a payroll to receive a salary. So that means that anything else, we talked about the partnership already. So now we're talking about if you're an LLC, not taxes, the other two, sole proprietor, you have a DBA, you're a side hustler, gig worker, independent contractor, all the things. The IRS doesn't recognize the they don't recognize the employee employer relationship. They only recognize the employer, right? They only recognize that there's just an owner. There's not an employee. The owner is not an official employee, right? So that means that you also fall under the partnership guidelines where if you're going to pay yourself, you are going to draw it, you're going to withdraw it from the net profit. From the net profit. So what does that look like? I made XYZ dollars. I spent XYZ dollars on business expenses. And what I am left with is my net profit. In the net profit, a lot of things happen there. We talked about this before. I'll just briefly say it since we're just talking about paying ourselves. But in that net profit, we got to do at least 5 things with that. Okay. The net profit is for taxes because that's where we get our tax money from. That's where we save money, okay, for the business. That's where we pay ourselves, and that's where we also invest, okay? Because sometimes we want to invest in certain things, right? Or we can be ahead for the next month's expenses. Okay, we can be ahead, have a jump start for next month expenses. So with that net profit, I mentioned we pay ourselves in there, right? And a lot of times when we have that net profit, we don't know what to do with it. Let's say the net profit, for sake of numbers, let's say in September you made 10K, you spent 5K, and you're left with 5K. You're left with $5,000. Many of you would think that, oh, I got $5,000 left over. I get to pay myself $5,000 and I'm good. And you're not, okay? If you are taking all of that net profit and you are not putting it in some of the buckets that we talked about, you're going to find yourself owing a lot of money at the end of the year when it's time to file your tax return. And this is how people get behind on taxes, because you're looking at, oh, well, all the money that was left over, it was for me, and it was not, right? We got to put that money in some taxes. We got to put that money in a savings bucket. You do have a pay yourself bucket, but as you can see, it's a third of what's going on. And then you have investing in, being ahead for the next month. So you don't have to wait for another deposit to come in order to pay your business bills, right? This is how you properly run the business, right? And I know many of you fall under this category of not being an S Corp or not being a C Corp. So this is going to help you. And I'm so glad we're talking about it, because this is like the signature part of my class when I teach my 90-day bookkeeping bootcamp. We dedicate a whole class specifically for paying you to determine how to pay yourself the right way so that you don't bankrupt the business. All right. And our last class for the year starts in October. We got October, November, December for our last 90-day class. It starts in October. And so on Wednesday, September the 25th, no, that's tomorrow. Wednesday, September 24th, we are having our last interest meeting of the year. So you can see if being a part of the 90-day bookkeeping bootcamp is for you. So what I'm going to do is, before I continue to talk to you about paying yourself in this entity, I'm going to leave a link in the comments for you to go ahead and sign up for the interest meeting, which will be tomorrow, September 24th at 6 p.m. Central Standard Time. Okay. So I'm going to put that in the chat for you on Facebook. All right. So let's continue. So when you look at paying yourself as a sole proprietor, as the business owner who's only a LLC, nobody else is in the LLC, independent contractor, gig worker, however you want to call yourself, it's all the same thing. It's all on the same tax form, the Schedule C or Schedule E. Schedule C for most people. The net profit is where you're going to get your pay from. But out of that net profit, with our example, out of that $5,000, how do I determine how much of the $5,000 that I get? Well, we talked about how the B word, I don't know if you can guess what that B word is before I tell you. The B word is what's going to save your business life. And that B word is budget, right? Knowing your personal budget. And if you follow my Fire Your Boss Friday lives, listen, when I tell you all of it is connected, all of it goes together. All of it goes together. All right. So in business, and we like to be like, well, I don't need my personal, that's separate from my business. Well, if it's so separate from your business, then why? Sorry, I'm gonna hurt some feelings. Why you don't have any money then? Why isn't there any money in the business? Because you gave all of it to yourself personally. So your personal does matter. What's going on with you personally does matter then. If you're going to pay yourself from the business, and if you are a person who is not an S Corp or a C Corp, then you need an additional strategy. You need an additional strategy to figure out how I'm going to pay myself without going broke in my business, without my business account going below zero. How do I pay myself? And this is where this is where the personal budget comes into play. How much do it cost for me to live personally? Let's start there. How much does it cost for me to live personally? And I gave y'all a free personal budget tracker so you can figure this out. And we also go through it in detail in the 90-day bookkeeping bootcamp. All right. And I'll drop it in the comments for the people on Facebook if you have not yet downloaded that. How much does it cost for me to live personally? Right. And if I'm someone who is still full-time in business, then how much of that do I need from my business if my job is going to pay for this part of it? Then how much do I need from my business to make up the difference? This is where the personal budget comes in. And the personal budget tracker, it does a really good job with visually showing you this, because sometimes we just keep stuff in our head. Sometimes we just keep stuff in our head and it does nothing for us A lot of us don't realize that we're visual learners and we need to be able to see what it is that's going on in our mind. We need to be able to see it. So when we put it on the spreadsheet, when we put out on the spreadsheet everything that I'm paying from rent, mortgage, car insurance, car note, groceries, loans, credits, credit cards, miscellaneous stuff, personal care, dining out, all the things, tithing, whatever it is. When I put out every single thing that I'm responsible for personally, and let's say for the purpose of this example, let's say we're full time in business, right? And we do our personal budget, and it shows us that we actually need $5,000 to live comfortably, to live, a peaceful life, to have all of our things covered, plus the nails and everything else that I want to do for myself. We find out that we actually need $5,000. Well, in the example, we got $5,000 left over in the business. But what happens is if you take all of that $5,000, as I mentioned before, then you leave yourself with no money for taxes. You leave yourself with no money for saving for your PTO fund, your rainy day fund, your client didn't show up fund, so you need some money. Like where's it gonna come from? It can't come out the sky, right? It's gotta come from a bucket. It gotta come from an account. And so that's how we know. If you follow my Fire Your Boss series, like how do I know when it's time to fire my boss? Because if I need $5,000 a month personally, but I'm having $5,000 left over consistently every month, you might think that is the right time to fire your boss, and it's not. You're going to be in full-time entrepreneurship, and it's going to be very tight. Money is going to be very tight for you if you do. So what does that look like? So what does that mean? So let's say I made the premature decision to fire my boss, and I'm full time in business. I need $5,000 a month. My business is producing a net profit of $5,000. So there's my $5,000, but it is extremely tight. What do I do? How can I continue to be in full time entrepreneurship and it not feel this way? Well, there's a couple things that you can do. Obviously, you can make more money. See about decreasing your business expenses. But also with that personal budget, you're able to look at, okay, I'm actually spending $400 in dining out. Do I really need to spend $400? Okay, I can X that off. So now I'm down to $4,600. Oh, I actually don't really need to go to the spa every week. I don't really need to go every week. So let me take out that, let's say about $200 a month. All right, so now I'm saving myself $600. Now I'm down to needing $4,200. Oh, you know what? I actually don't need to take this dance class that I was taking. Well, at least if I can just take it another time. But in this season, I'm deciding that I don't need to take this class right now. So let's say that's $100. So now we're down to $4,100, and our net profit in our business is 5,000. So now I have saved myself $900 that still can be in the business. Now I have some money for some taxes. Now I have some money for some savings. Now it won't feel so tight. Life won't feel so tight right now. You see how we did that? That's we were doing this from, if you made a premature decision. But look how, if you would apply that to you right now, if you're still full-time in your job or in your career, look how we were able to determine what I need from my business based off my personal budget. So now I know how much to pay myself, and I won't take more than that. Okay? And I won't take more than that. So that means that if I know I'm always going to need $4,100 a month for my business to live, then I'm only going to take $4,100 out. I don't care if my business did numbers and let's say it did 50K. I'm not taking out no more than the 4,100. Okay? That's how you truly run the business. That's how you truly make sure that you're on the right path to properly paying yourself. Okay? When you're consistent, because you have to think about it. If you were working for an employer and the employer did real good that month, is it going to pay you an extra on your paycheck. Nah, if they supposed to just pay you $4,100, that's all you gonna get. Maybe at the end of the year you'll get a bonus, or midway through the year, and you can do that. Midway through the year, end of the year, give yourself a little extra, give yourself a bonus. Okay. But if you're supposed to, based off what we come up with, if you're supposed to only pay yourself that $4,100, then that's all you get. Yeah, the business did good. It might have had some really good months. And you're like, oh, I can just give myself a little bit more because my business is doing better. So I can just start paying myself more and more and more. But then you find yourself, what happens is, what we fail to realize is that whatever money that we make personally, we get as many expenses to make all of that go away for some reason. I don't know what it is, but like if your job pay you $4,100 a month, you gonna have a bill or something for that full $4,100. You gonna have something for some reason, and you find yourself needing a side job, needing something else, because all of that money is designated to go somewhere. And if you start doing that in your business, where you start paying yourself more and more and more, and you get to a point where, oh, you made your expenses go so high up to, and let's say you can't continue to meet that, then you find yourself being in the bind. So that's why I say, when we know how much it takes for us to live personally, okay, comfortably, if it's that $4,100 a month, that's it. That's all I'm going to see. Yes, I'll pay myself a bonus, and I'm going to be strategic about when those bonuses happen, because that's not going to be every month, right? And then I'll go from there. And that's how I'm able to have money in my business. That's how I'm able to not be bankrupt in my business. That's how I'm able to have the taxes for my business. That's how I'm able to have the savings. So when things come up, these events come up, and I want to go to these events, or I want to go travel to this retreat, or whatever it is, I have the money for it. It's coming from somewhere. And I don't have to squeeze the money out of any place else, because I have the designated bucket for investing, for my savings. I have the bucket for it. And when it's time to file my tax return, I have the bucket for my taxes. There's something in there. If I didn't pay it out throughout the year for quarterly taxes, I have something in there. So you see, there is strategy around paying yourself. Don't let anybody think that, oh, you just pay yourself whatever. You just transfer whatever just to cover this bill in your home. Listen, be strategic about it. Be strategic about it. And I'm so glad that in the 90-day bookkeeping bootcamp, I show you specifically how to do this. So I put the link in the comments for you to join and sign up for our interest meeting, which is tomorrow, actually, at 6 p.m. Central Standard Time, September the 24th, where I will give you all the details of what's included in our 90-day bookkeeping bootcamp. Okay. We're going to make sure you get out of the chaos and you have the clarity you need in order to financially run your business the right way, how to manage your money, right? Moving away from the spreadsheet of just writing out your income and expenses to moving into an accounting software and knowing how to use it based on your needs, based on what you have going on in your business. And then having that strategy of what to do with your net profit. How much are we actually allocating for your personal pay? How much are we allocating for savings? How much we're allocating for taxes, so that you can sleep good, real good at night, knowing that all things are covered, right? Knowing all things are covered. So the 90-day bookkeeping bootcamp interest meeting is tomorrow, September 24th, 6 p.m. Central. Make sure you sign up for that. Actually, you need to sign up for that right now, because we're meeting tomorrow. And then for you who want to get a jump start on your personal budget, okay, because we do cover that in the 90-day bookkeeping bootcamp, so you would need to have that done. If you want to get a jump start, go ahead and download it. It's free. Download it so you can see where you are. How much money do it really cost? How much money do I actually spend in a month? Because just opening up your bank app or logging into your bank just to see how much money is left over, that's not the move. Okay, trying to look through all of the expenses just to make sure that they're clearing out, that's not the move. It's not really telling us where did the money go. Okay, Where did the money really go? So that's what the personal budget tracker is going to do for us. It's going to show us where is the money going and how much of it is going out. Because I might find that I need to stop doing some stuff. Okay? That's how I found out I need to stop eating Wingstop 3 times a week. Okay? And your girl has lost a lot of weight. I've lost, now I'm down to 24 pounds. Not only because I am on the health journey. If you're following me, I'm on the health journey to make sure I am better from a spiritual, mental, emotional, physical, financial state. I'm covering all areas. But also because I know my personal budget, I'm looking at this dining out. And I'm like, why are we eating Wingstop 3 times a week, first of all? Why? What's making me? I need to cook and need to do a little bit more cooking. That's why I had this belly over my pants line because I was eating too. I was doing the most. And so when I had this holistic approach to my life, not only did I save some money, but I shaved off some pounds. Not only did I save some money, I saved some pounds off that scale. Okay? That was neither here or there. That was extra. All right, so thank y'all for joining me this Tuesday. We are here every Tuesday, actually at 7 a.m. Central Standard Time, giving you a tax talk on business, taxes, or a finance topic. Today, it was on finances. So I hope you have a better understanding on how to pay yourself, knowing what you can and cannot do, what some business entities allow and what some entities don't, okay, based off of IRS guidelines. We are here. We'll be back here next Tuesday giving you another tax talk. Again, make sure you sign up for the 90-day bookkeeping bootcamp interest meeting, which is tomorrow, September 24th at 6 p.m. Central Standard Time. And also, I put in the free personal budget tracker in the comments for you to download so you can start looking at your personal budget so you can start seeing where you are. And I want to give a shout out to the people who joined me live. Thank you, G Code. Thank you, Melissa. Thank you, Latasha and Kendra, for joining me live this morning. I hope y'all have an amazing start to y'all's Tuesday, and I will see you next week.